The letter is already printed, your name may already be on it, and if you are anywhere between 55 and 80 in this country, there is a real chance it lands in your letterbox within days. It looks harmless. Gray envelope, government logo in the corner. Easy to leave on the kitchen bench for a week. That is exactly what they are counting on. Here is the plain truth. Straight up. Services Australia is pushing out a wave of letters right now that touch how your pension is calculated, what you are deemed to be earning, and what you must confirm before a cutoff date, and if you miss the date, the money that stops is your money. I know how this works because I have sat on hold with Centrelink for the better part of a morning, watching a payment I relied on drop without a single human being ringing to warn me first. But I am not going to leave you sitting in fear. By the end of this, I will show you the one thing you can do this week that most people over 60 are never told. Clearly a step tied to a specific rule inside services, Australia's own guidelines that can protect thousands of dollars you are owed. And it does not matter if you are already on the pension, about to apply, or convinced you earn too much to qualify. This still reaches you. So stay with me, because the part that costs people the most is not the letter. It is what they assume the letter means. Let me tell you what I actually saw. A few years back, my neighbor, good bloke, worked concrete his whole life, got one of these letters and did nothing because he figured if it were important, someone would call. 3 fortnights later, his payment had dropped by more than $90 a fortnight and no one had explained why. By the time he sorted it out, he had lost the better part of $600 he was never going to see again. That is the moment I decided I would read the fine print so people like him did not have to. Now here is what is really going on and why the timing matters so much. For a long stretch, the government kept something called the deeming rates frozen. Deeming is the part almost nobody understands, so let me make it simple. Centrelink does not look at what your savings and investments actually earn. They pretend they deem that your money earns a set rate, whether it truly does or not. If your money earns less than the deemed rate, tough luck. They still count the higher pretend number against your pension. Those deeming rates were held down at 0.25% on the lower tier and 2.25% on the upper tier. That freeze protected a lot of pensioners while interest rates were climbing, but a freeze is only ever temporary, and the date it was tied to has been a moving target that most people have completely lost track of. The moment those rates lift, the pretend income Centrelink counts against you goes up, and when the counted income goes up, the pension going into your account goes down. Not because you earned a cent more, because a number in a government computer changed. That is the trap. The change does not feel like anything. No warning bell, just a smaller number next payment. Therefore, the letters landing now matter more than they look, because some of them are asking you to confirm or update your financial details, the exact figures that get fed into that deeming machine. And if the figures on file are wrong, or out of date, or you ignore the request entirely, the calculation runs anyway, using whatever they already have. Silence is not neutral. Silence gets read as agreement. Let me put real numbers on the table so you can see what is at stake, because vague warnings are useless. Right now, the maximum single-age pension, once you add in the supplement and the energy supplement, sits at around $1,149 a fortnight. Over a full year, that is close to $29,800 for a single pensioner. For a couple, combined, it is around $1,732 a fortnight. That is the ceiling. That is the most you can get. Now here is the part that stings. Every extra dollar of income Centrelink counts against a single pensioner above the free area reduces the pension by 50 cents. And on the asset side, for every extra $1,000 in assets above your threshold, your pension drops by $3 a fortnight, which works out to $78 a year for every single $1,000 over the line. That taper is brutal, and most people have no idea how sharp it is until it has already bitten them. So when a letter asks you to update the value of your car, your caravan, your contents, your savings, that is not paperwork. That is the exact lever that moves your payment up or down. Guess too high, or let an old inflated figure sit there, and you are quietly handing back money you are entitled to keep. But the deeming and the assets are only the first layer. Because there is a date sitting behind all of this that almost nobody circles on the calendar, and that date is where the real pressure builds. Twice a year, On the 20th of March and the 20th of September, the pension is indexed and the thresholds shift. Those two dates are the heartbeat of the whole system. The free areas move, the cutoff points move, the deeming thresholds move. And here is what the letters almost never spell out in plain language. When the thresholds shift, some people gain a few dollars, but others get pushed the wrong side of a line they did not even know they were standing near. I have watched people lose their pension entirely, not reduced, gone because their assets crept a few $1,000s over the cutoff during one of these reviews. And with the pension went the pensioner concession card, the cheaper medicines, the discounts on rates and Rego. Losing the payment is bad enough. Losing the card attached to it is what really hurts, because that card can be worth thousands of dollars a year on its own. Therefore, the letter in your box is not asking a simple question. It is deciding, quietly, which side of the line you land on. And the people who wrote that system are absolutely relying on the fact that most Australians over 60 will not read past the first paragraph. Now let me deal with the thought that is probably forming in your head right now. You might be thinking, this is all very well, but it does not apply to me. Maybe you are not on the pension yet. Maybe you are 55, 60, 63, still working, still years off. Or maybe you are the opposite. You have got a bit put away, a self-funded retiree, and you have decided you earn far too much to bother with Centrelink at all. I need you to stay right here, because this is exactly where the most expensive mistakes get made. Start with the ones who think they are too young. The qualifying age for the age pension is now 67. It moved up in stages, and it locked in at 67 from the 1st of July, 2023. That means if you are in your 50s or early 60s right now, 67 is your number, full stop. But here is the trap for the young ones. The assets and income you are building today, the way you structure your savings, the way you hold your money, that is what gets tested the day you apply. People spend 30 years never thinking about it, then hit 67 and discover a decision they made years earlier is the thing keeping them off the pension. The time to understand the rules is not the week you apply. It is now. And for the ones who think they earn too much, this is the one that makes me want to grab people by the shoulders. There is a card called the Commonwealth Seniors Health Card, and it is not for pensioners at all. It is specifically for self-funded retirees over pension age who do not get the pension. The income test for that card was lifted, and lifted generously. A single person can now have an adjusted taxable income of around $99,000 a year and still qualify, and a couple combined can be up to around $158,000 a year. There is no assets test on it at all. None. That card gets you cheaper prescriptions under the pharmaceutical benefits scheme, a lower safety net threshold, and access to bulk billing incentives and state and territory concessions on things like electricity, rates, and public transport. I know self-funded retirees sitting on a comfortable balance who have been paying full price for their medications for years out of pure pride and the assumption that Centrelink is not for them. That assumption has cost some of them thousands of dollars they simply did not need to spend. So do this today, whatever camp you are in. Write down your date of birth and work out exactly how far you are from 67. Then write down your rough income for the year. If you are over pension age and under those seniors health card limits I just gave you, you have a claim to make, and you should not wait for a letter to tell you, because that letter is never coming. Nobody sends you an invitation to money you have not asked for. That is the step you can take without an advisor, without a fee, without permission from anyone. And if you want to go even deeper into exactly how these rules connect and what the full picture looks like for your situation, I have put together a resource that lays it all out. It is called Pension First, and there is also Pension Edge and the full system for those who want the complete picture from every angle. These books walk through the same rules we are covering here: the deeming traps, the assets test, the claiming windows, the cards most people never ask for written in the same plain language, so you can go back to it anytime a letter arrives and know exactly where you stand. You will find the details in the description below. Now, back to the letters and the dates, because this is where things get sharp. But updating your details and knowing your card are only the defensive moves. Now I want to show you where the system quietly works against you, because once you see who benefits from the confusion, You will never look at one of these letters the same way again. Think about how the whole thing is designed. The pension is not backdated. Let me say that again, slowly, because it is the single most expensive fact in this entire video. The age pension does not start from the day you become eligible. It starts, in almost every case, from the day you lodge your claim, not a day earlier. So picture what actually happens to people. Someone turns 67, they mean to sort out the pension, but there is a form, and there is proof of identity, and there is a bank statement to dig up, and life gets in the way. 3 months drift by. They finally lodge the claim. And every single fortnight in those 3 months, money they were fully entitled to is simply gone. Never paid, never recovered. For a single pensioner near the full rate, 3 months of delay can be more than $7,000 evaporated because nobody told them the clock does not wait for them. Who benefits when people lodge late? The system does. Every fortnight you delay is a fortnight the government does not pay. There is no penalty on them for your delay and no reward for you being early. The incentive runs entirely one direction, and it runs against you. Therefore, the timing of your claim is not a formality. It is one of the biggest financial decisions you will make in your 60s, and it is one the letters will never, ever hurry you along on. They will happily process a late claim. They will never ring to say you are leaving money on the table. And it gets sharper because there is a second clock ticking underneath the first one. When Services Australia sends you a request to confirm your details or respond to a review, that letter has a deadline printed on it, often 21 days, sometimes 28. Miss that window, and your payment can be suspended. Not adjusted, suspended. Stopped while they wait for you. And getting a suspended payment switched back on is a far slower, far more painful process than simply answering on time would ever have been. I have seen a woman in her 70s have her payment frozen over a review letter that went to an old address after she moved, and she did not even know a deadline had passed until the money stopped. It took weeks to unwind. Weeks with no pension. Imagine that at 74, trying to cover rent and medication while a department decides when to turn your income back on. That is why I keep hammering the same point. The letter is a clock. The moment it arrives, the countdown starts. And the countdown is not on your side unless you make it your side. Now, let me widen the lens, because there is a bigger shift happening that ties all of this together, and it is the reason these letters are going out in the numbers they are. The whole system is moving toward putting the responsibility on you. It used to be that a person at a Centrelink counter would walk you through things. Those counters are thinner on the ground now. More and more of this is pushed online, into the MyGov portal, into automated reviews, into data matching, where the tax office and the banks and Centrelink quietly compare notes on you without a conversation. When their data and your data do not line up, a letter gets generated, and the burden of fixing it falls on you, on a deadline, whether or not you ever understood the mismatch in the first place. This is the part I want you to really sit with. The confusion is not an accident. A system this complicated, with thresholds that move twice a year, with deeming rates that pretend your money earns something it does not, with claims that are not backdated and reviews that suspend your payment if you blink, that complexity has a beneficiary, and it is not you. Every pensioner who gives up halfway through a form, every self-funded retiree too proud to claim a card they qualify for, every person who lodges 3 months late saves the system money. Your confusion is, in the coldest accounting sense, a feature. But here is the good news, and this is where you take the power back. The rules are complicated, but they are not secret. They are written down, and once you know the specific things to check and the specific things to do, you stop being the person the system relies on to lose out. So let me give you the finale, the thing I promised you at the start. The step most people over 60 are never told clearly, straight from Services Australia's own rules. If you are approaching pension age, you do not have to wait until the day you turn 67 to lodge your claim. Services Australia allows you to submit your age pension claim up to 13 weeks. That is a full 3 months before you actually reach qualifying age. Read that again. 13 weeks early. This is the single most powerful move available to you, and here is exactly why it changes everything. Remember, the pension is not backdated. It starts when your claim is processed and granted, not when you become eligible. Claims take time to assess, sometimes many weeks, because they have to verify your identity, your assets, your income, your residency. If you wait until your birthday to lodge, you are lining up behind a processing queue while the eligible fortnights tick past unpaid. But if you lodge in that 13-week early window, Services Australia can assess everything in advance, and your payment can begin from the very day you reach pension age, not weeks or months later. That gap, that difference between lodging early and lodging late, is worth thousands of dollars in real payments that land in your account instead of vanishing into a processing delay. And almost nobody tells you this clearly. It is buried in the claiming rules. It is not printed on a billboard. It is exactly the kind of quiet, specific fact that separates the people who get every dollar they are owed from the people who lose the first 2 months of their retirement income for no reason but timing. So here is precisely what to do this week. If you are within 13 weeks of turning 67, that is, if your 67th birthday is coming up in the next 3 months, start your age pension claim now. Do not wait for the birthday. Get your identity documents together, get your last few bank statements, get the current value of your assets, and lodge. If you are not there yet, mark the date 13 weeks before your 67th birthday on the calendar in big letters, because that is the day your window opens. And there is a companion move that stacks on top of this, and it is just as underused. It is called the work bonus. If you are on the age pension and you do any paid work at all, even a few shifts, even casual, even seasonal, the work bonus lets you earn up to $300 a fortnight from work without it counting against your income test. And any unused amount rolls up into a work bonus balance that can build to thousands of dollars, which means you can take on a burst of work, say helping out over a busy season, and shelter a big chunk of that income from the pension calculation. On top of that, new pensioners now start with a work bonus balance credited from the beginning. Most people never claim the benefit of this because they assume any work at all will slash their pension. It will not up to those limits. And knowing that can mean the difference between saying no to work you would have enjoyed and keeping both the pay and your payment. Put the two together and you have real control. Lodge your claim in the 13-week window so you never lose a fortnight to delay. Use the work bonus so a bit of paid work does not cost you your pension. And keep every letter, answer every review before its printed deadline, and confirm your asset figures are current and not some inflated old number dragging your payment down. Let me be crystal clear about the assets figure, because this is where people quietly leave money behind. The value Centrelink wants is not what you paid. It is what your things are worth secondhand today. If you sold them, your 10-year-old car is not worth what it was. Your furniture, your white goods, your tools, your contents, the fire sale value of all of it, added up, is usually far lower than people guess. Every $1,000 you overstate is $78 a year of pension you are throwing away because of that $3 per fortnight taper. So when a letter asks you to update your assets, do not rush a high number just to be safe. Value it honestly at what it would actually fetch, and you may find your payment should be higher than it is right now. And if you have already lost some pension in a past review, or you are staring at a letter with a deadline that has you worried, do not go quiet. Silence is the one thing the system rewards itself for. Ring them, use your MyGov account, respond in writing, and get it on the record before the deadline printed on that page. A payment answered on time is a payment protected. A payment ignored is a payment suspended. I want to bring this right back to where we started, to that gray envelope on the bench. The difference between the person who loses $600 and the person who keeps every cent they are owed is not luck, and it is not who has an accountant. It is simply who opened the letter, understood the clock, and acted before the date on the page. That is the whole game. The rules were made complicated on purpose, the deadlines were made quiet on purpose, and the system was built assuming you would not read this far. You just did. So here is what you have really done today. You did not just learn about a letter. You took back the one thing they were counting on you not having enough warning to act in time. You are now the person who lodges early instead of late, who values their assets honestly instead of blindly, who claims the card they were too proud to ask about, who answers the review before it suspends the payment. You are not the easy mark anymore. That is who this is for. The Australians who refused to be caught out by a rule that was changed quietly behind their back, who read the fine print so a government computer cannot decide their fortnight for them, who look out for the bloke next door who would have left that letter sitting for a week. Now I want to hear from you, and I mean this specifically. Tell me in the comments, have you ever received one of those Centrelink review letters with a deadline on it, and did you know what it really meant when it arrived? Or did it sit on the bench like my neighbors did? And tell me which part of the country you are watching from, because I want to see how far this reaches, from the city to the bush. Write it down below. This audience does not speak up enough, and your comment is the thing that pushes this warning in front of the next person who needs it before their date passes. If you want to stand with the Australians who refuse to be blindsided, the ones who get the warning early instead of finding out after the money is gone, then come along with me for the next one. Because there is another change coming to how bank accounts and everyday transactions are being watched and reported for people over 60, and there is a specific threshold in it that most people have not heard a word about yet. I will break that one down the same way, in plain English, before it costs anyone a cent. Do not leave that letter on the bench. Open it, read the date, and act while the clock is still yours. Because in this system, the person who moves early is the only person who never gets caught out. If your name's on one of those letters, there's more you need to do, and that's exactly where I pick up inside the Pension Watch. I walk you through the full Deeming rate protection strategy, right where this video stopped. And you can ask me your own question. I answer you myself. No bot. You belong here with older Australians just like you. Just point your phone's camera at the code. Cancel anytime. One click.